two big macro and geopolitical events of the week ahead will both come from the USA. First, on Tuesday the 6th of November, we've got the US midterm elections. The Democrats will be trying to wrest control of the lower house of representatives, or the upper house, the Senate, from President Trump and the Republicans. Second, and perhaps of more direct importance to financial markets, we've got this year's 7th meeting of the Federal Open Markets Committee, or FOMC, as the US Federal Reserve sets American monetary policy. Chair Jay Powell and his colleagues are expected to leave the upper band of the headline Fed funds rate unchanged at 2.25%, but to nevertheless lay the groundwork for the 4th increase of this year and the 9th of this upcycle at the meeting slated for December. In addition, the Fed's also expected to confirm that it will continue to reduce quantitative easing at a rate of $50 billion a month, an annual run rate of $600 billion a year, and that's no small sum, even for a central bank whose assets had swollen to $4.5 trillion during the lifetime of its bond buying scheme. Asset prices feasted on this cheap liquidity provided by QE between 2008 and 2016, and now they're having to go cold turkey as the Fed withdraws that liquidity, which may help to explain why stock and bond markets have become more volatile of late. This chart shows headline interest rates and the overall size of the Fed's balance sheet. The next one shows the Fed's assets against the S&P 500 index. We may be in for some interesting times, and given the complaints from President Trump about tighter monetary policy and the autumn stock market wobble, this is a big test for Chair Powell and the US Central Bank's determination to get American interest rates to somewhere near normal in time for the next recession, whenever that is. Remember, the Fed has cut interest rates by an average of 5.25 percentage points during a down cycle. That's pretty hard to do if your starting point is 2.25%. On the home front, we've a busy week of corporate news ahead, with around a dozen FTSE 100 members and a good selection of FTSE 250 and small cap firms scheduled to issue results or provide trading statements. They include British Sugar and Primark owner Associated British Foods, Imperial Brands and grocer Morrisons on Tuesday the 6th of November, ITV and house builder Persimmon on the 7th, drug giant AstraZeneca, Burberry, National Grid and another grocer, Sainsbury, on Thursday the 8th. However, for me, the stock most likely to cause a fuss in the week ahead is Marks & Spencer, when it releases first half results on Wednesday the 7th of November. Shares in M&S are down around 13% over the past 12 months, and it's been another difficult year for the high street bellwether. Chief Executive Steve Rowe and Chairman Archie Norman stunned the market back in May when they announced a store closure programme and a £514 million exceptional charge for the year to March 2018. That was even higher than the £437 million hit taken in 2017 and took the total cost of so-called exceptional restructuring charges and write-downs and costs to £1.4 billion over the past 7 years. One positive sign for shareholders going forward would therefore be a reduction in these supposedly exceptional costs and a closing of the gap between reported and adjusted numbers. That could point to the potential for improvement in performance and that the quality of profits could be getting better as well as the quantity. For the record, in the first half last year, M&S reported pre-tax profits of £118 million with exceptional charges of 101 for a total adjusted pre-tax number, i.e. earnings before bad stuff, of £219 million. They're your benchmarks for the first half numbers this time around. Attention will also focus once more on like-for-like sales momentum. M&S did away with its traditional first quarter trading update in July, so it could focus on the long term. So our benchmark here is the fourth quarter statement, which alas didn't read too well at either food or clothing and home. Food sales fell for the 5th straight quarter, year on year, and the decline at clothing and home re-accelerated after 3 quarters of almost coming in flat. Even allowing for the vagaries of the British weather, that was disappointing stuff. Besides like-for-like sales growth, profits momentum and profit quality, investors will also look toward the dividend. At the first half stage last year, M&S paid an interim dividend of 6.8 pence on its way to a full year payment of 18.7 pence per share. A repeat of that will put the stock on a dividend yield of 6.2% on a share price of 300p, which may be enough to persuade some to stick around and see if Mr. O and Mr. Norman really can turn the company around. On a full year basis, stated pre-tax profit peaked in 2011, and it's gone nowhere fast even if you strip out all the supposedly, if frequently occurring, exceptional items over the same time frame. Thank you for watching, and I look forward to seeing you next time.